Hey, what's up, y'all? Steve Peterson of Infinity Investments. Today's video is on 5 things you should consider when buying your first commercial or investment property. Now, I'm doing this video because this week, for whatever, and today is July 23rd, 2020, I have got this question 3 times. I think there's a lot of people who have either got stimulus money or they just got some money that they want to put in real estate, maybe taking out of the stock market, put it in the real estate, although the stock market's doing great right now. I think people just feel the tangible benefits of real estate, particularly investment property. And so I got that question 3 times this week, and I wanted to address it. So here's what we're doing in this video. We're going to talk about these 5 ways. And number 1 is you need to educate yourself on the real estate investment business, okay? The real estate investment process, how to analyze property, all this stuff. You need to get educated. That is the very first step. You don't want to just take some money and say, I got some money, it's time to buy properties. And that's really with anything that you're going to invest in, whether that's stocks, whether that's futures, whether that's, Bitcoins. You need to get educated in the process. And to take that a step further in step 1, is that you need to develop a plan. So in Robert Kiyosaki's book, Rich Dad's Guide to Investing, he talks about investing as a plan, not a product. So it's not stocks, it's not real estate, it's not bonds. Those are the vehicles to get you to your goal. And so what you gotta do is start with the end in mind. You say, hey, I wanna retire, or I want to hire someone else to run my business, or I want to kick back and just only do real estate or investing full time at X date, okay? That's going to require a certain amount of passive income coming in from your assets. So you start with that goal in mind. Now, in the Kiyosaki world of cash flow, he recommends that you at least have the amount of passive cash flow coming in on a monthly basis equal to your monthly expenses. So if you got 10 grand coming in a month of passive cash flow and you've got 11 grand of expenses, you're almost there. You need to have 11 grand a month of passive cash flow coming in if you've got 11 grand a month of expenses to really truly be what he calls, financially independent, or in his game, the rat race, he calls leaving the rat race to the fast track. That just simply represents you're at a point where your assets are paying for all the expenses, okay? In an advanced way of looking at it, it's really 2 times your monthly expenses in the amount of passive cash flow. If you did it that way, if there's a bump in the economy, then all your bills are gonna be paid from your assets, not your physical production, okay? Like I run a brokerage business. At one point, I wanna sit back and have my buildings and assets paying for all my lifestyle, so I don't have to run the business. I can hire someone, or hopefully one of my kids to take over the business or something. I just won't have to be physically there anymore. So you have to start with that plan in mind, okay? And you really need to get educated on the process, okay? You need to subscribe to this station, all right? Pay attention to our videos. Look at there's other people you can follow out there in the real estate investment world. There's a guy by the name of Jay Morrison who puts out excellent content. There's a guy by the name of Charles Blair, the mad scientist, who puts out amazing content. There's a dude by the name of Michael Blank on apartment buildings, puts out great content. The king of commercial real estate is Peter Harris. You want to check out his content. Those are just some great people along with us that you can follow to get educated on the process, okay? And there's a couple books particularly that I think are great. First of all, Peter Harris's Commercial Real Estate for Dummies book, an amazing book. Robert Kiyosaki's Rich Dad's Guide to Investing, I totally recommend it. But my favorite book is Don Peoples' book, The People's Principle. Don is at one time, and I think he still is, the biggest black developer in the country. And I love the book because he talks about starting when he was 16 or 17 as an appraiser, all the way up to he talks about building $100 million projects. Read those books, get educated, but have a plan and start with the end in mind. That is literally step 1. Don't do investing if you haven't got educated and put a plan together. Step 2, you want to master the property analysis process, all right? You want to master that, all right? And the reason you need to master that is because you have, in real estate investing particularly, there is a lot of risk, okay? There's inherent risk with the property and the operations, and there's also the mortgage risk, the debt risk, okay? And the better you can and realistically analyze properties to know what the property is today, what it has the potential to be in the future, the better off your investment's going to be, okay? So when I started off in 2003, I got started in the real estate business by getting educated, and I ordered the Carlton Sheets, no money down investment system. Where he talks about creative financing a lot, but you know what he spent a lot of time on in that course was how to properly analyze properties. You have to analyze these properties for the cash flow that they generate, and you really need to make sure that that property, especially if you're starting off, that first property must create a positive cash flow. There's other people that will argue where you can buy properties and they grow in value and you buy for the appreciation. And once you get a little bit more sophisticated, once you get more cash in the bank reserves, you can do a little bit of that stuff. We're talking about what are you going to do when you first get started. You need to make sure you analyze the property to make sure it produces a positive cash flow. Now, I've got several videos on my YouTube station where I break down property analysis in depth, so check those out. Also, if you're serious about this as a business, you might want to consider taking a CCIM course. Okay, CCIM, the intro course and the CI 101 investment analysis course is the best course in the business on property investment analysis. Okay, that's not that course can get expensive. I think it's about $1,500, give or take, but it is well worth it. At the very least, get very dialed in on how to analyze properties to figure out what the net operating income is and what the cash on cash return is going to be to you based on how much cash you're going to invest. Very, very, very important thing. And then once you really understand it, you need to practice. You need to get deals, even deals that you might not be interested in, and practice analyzing them, running the income and expense. And also understand, when you're looking at a property, you want to look at the historical financials, the last 2 or 3 years financial statements, but you must create the pro forma, the projection. That's what pro forma means, the projection of what the investment's going to look like in the first year that you own it, and maybe over the first 3 to 5 years that you own the property. You got to do that because things can change. Give you an example. You look at the owner's profit and loss statement, say they own the property since the 70s. Look at the numbers look great. And you just based everything off that, and then you buy the property, and something changes. One thing that's for surely going to change is especially in the state of California, but anywhere, is the property tax base. If somebody bought the property way back in the 70s, they're going to be paying a very low amount of property tax compared to what you are going to be paying when you purchase that property in today's market. That's why you need to understand the past and then build in the numbers for the future. Very, very important. That's step 2. Master the property analysis process. Now, step 3, when you're buying the first time investment property buyer, is that you need to build a team, all right? You need to build a team. Do not try to do this alone. Important members of your team, probably first you need to get a financier, a loan broker, a mortgage banker, somebody, if you want to go to the bank that you usually do business with. And I always suggest get 2 or 3 opinions and settle up on the financier that you want to work with, because you need that person, and you want to make sure you're working with someone who has a specialty in what you want to buy. If you want to buy multifamily, you need to get somebody who has a specialty in multifamily. If you want to buy office, retail, somebody who's done a lot of office and retail deals. Industrial, same thing. Single family or 1 to 4 units, you want to work with somebody who this is what their expertise is, not somebody who's a generalist who does everything, because they're not going to have an expertise. You want to work with experts in this business. You also want to have a broker on your side, okay? Particularly because a lot of investors don't, especially new folks, don't realize that when you work with real estate brokers to find property, you don't have to pay them, okay? The commission comes from the seller out of the deal, all right? And a lot of times, and here's the other reason why you want to work with brokers, brokers always have properties that, for say, they have listed for sale, but then they always have properties that they're going after to list for sale, meaning that those properties are not yet on the market. And if you're working with an expert broker, which again is what I recommend, somebody who is an expert in that product type, an expert in that area, they're not only going to have properties that they have listed for sale, they're going to have properties that they're working to bring to the market and they can show you possibly before it hits the market. All right. You also are going to need property managers. Unless you have that experience already, you need to hire professional property managers, especially on your first one. Okay. If you get the hang of it, you say, I like managing properties, then you can do it. Start off with a pro. All right. Now, you're also going to need to talk to an accountant, one that understands real estate. I advise a CPA, not H&R Block, okay? Because you need to figure out what kind of entity that is going to be best to set up for your form of ownership and what you're going to do. All right, you also need, and on that note, you need a lawyer. Now, be careful on this because the lawyers are the ones who stick you up front. They make you pay a lot of money. But, again, you want to get a real estate lawyer and somebody who can set you up an entity, an LLC, which I recommend LLCs, but I'm not a lawyer. Talk to one. Set your LLC up, set your corp up, set your trust up, and then advise you on some things in regards to the contract. And then finally, you want to talk to your financial planner if you have one, because you want the real estate investing to be a part of your overall plan. Investing is a plan, whether it's real estate, stocks, whatever. It's a plan, not a product. So you should be having some sort of financial advisor that you're working with, at the very least for the necessary insurances. And you just want to let them know, hey, I'm out here, I'm buying some investment property. Do I need to get more? Do I need to extend my insurance policy? Do I need to, adjust my stock portfolio? Or I just want to let you know what I'm doing because we're working together. So build your team. Don't do this thing alone, man. This can be a complex process, You can make it, you can do it, but be more efficient. You can accomplish more by having these people in place to be able to go forward and get things done. All right. Now, step number 4, very important, define your investment criteria. Okay. Here's what I mean by investment criteria. Say you're looking for apartment buildings where you say, well, look, I'm looking for a 10 to 20 unit apartment building that's going to generate a minimum 7% cap rate. I'm looking to make a minimum 9 or 10% cash on cash return. We want to buy in an area by the way, that has positive job growth, and a positive population growth. Okay. And maybe you say, hey, we want to invest in this particular neighborhood, in this particular city. You can define what your investment criteria is. The bottom line is you need to define it, though. You need to write it down and you need to stick to it. All right, figure out if you're going to make this investment, what's your required rate of return, and usually your minimum. You need to set a minimum. Obviously, you want to make the maximum, but you need to have a minimum. I will not do a deal unless I can make X amount of return on this property, which is why you need to master property analysis, right? So you know what returns are and how to calculate them. And then, but when you define that criteria, you got to have that set minimum. But also, I think you got to have, particularly every product type is different. So you need, if you're in apartment buildings, you want to have some particulars in there, such as, I don't want to buy properties that have flat roofs, or I don't want to buy properties that have master, gas and electric, or I don't want to buy properties that have master hot water heaters. Okay, those are just a couple of things. Now, depending, in California, you can kind of get away with a flat roof, but nobody really wants to deal with master meter buildings. Okay, and a lot of those are in the South. I know Texas has a lot of master metered buildings, also a lot of master, water heater buildings. It's just something I think you should probably avoid. All right. So the bottom line is you just want to map out your criteria. The more experience you get, a lot of this comes from experience. When I work with different investors and my own experience as well, you have done something, did a deal, and maybe, something rubbed you the wrong way, and look, I'm not doing this again, and that's part of your criteria. But you want to set forth something. As you get educated, you read, you go to webinars, seminars, when we can go back outside and have seminars, you're going to see different investors' criterias. Create your own, but look at what the professionals are doing and build that in. My biggest criteria is the property must positive cash flow. If I'm representing you as a broker or something that I'm doing with partners or something I'm doing, it's got to have a positive cash flow for sure. Going in, and it has to have an opportunity to grow that in the future. Very, very important. Okay. Now, moving on. Last but certainly not least is number 5, and that is get good at finding properties. And do not settle for simply what is on the market. All right? You got to get proficient at finding deals that nobody else is seeing. All right? That is a art and a science, a discipline. It's a tough thing, but something you got to learn. Now, you got to start with understanding what's on the market, okay? And I really advocate now. I'm a broker and I run a brokerage company. I was an investor before I was an agent and broker. And I worked with a lot of different investors, and the top investors that I know all work with brokers, because brokers find properties usually better than anyone else, because guess what, y'all? That's their core business, finding properties to list or to represent buyers for. That's how we make money, right? So you want to be tapped into those guys. Now, you don't have to just simply rely on what the broker brings you. You can also go on your own, do some research, see what's happening in the foreclosure world. Okay, maybe look at some tax liens. All right, drive a particular neighborhood. This is an old school tactic, but it's called driving for dollars. You identify a neighborhood and you drive around. You're looking for vacant, abandoned properties where the weeds are just as tall as you in the front yard, properties that maybe have a bootleg for rent sign, that bad handwriting, because that's an owner who has that, not a property management company. You just want to look for signs of opportunity, okay? And you also want to look for things off the beaten trail. Now, a lot of my clients will sometimes find a deal, right? And bring it to me and say, hey, I want to do this deal, but I want you to walk me through this as an advisor, because I'm an expert in the business. And not only do I find people deals, but I also advise them. So from time to time, an investor will say, hey, Steve, I got this property. Let's do this deal. But I need you to walk me through this, because there's a series of processes that are involved in buying an investment property where we can help out, okay? So if you work with a broker, don't screw them over, have them doing a whole bunch of work for you and then not use them, okay? You don't have to pay them, and they can be a very good benefit to you. But make sure you are working with one to find new properties, but you are not just simply relying on that. You are taking to the streets yourself. You are telling people in your network, I'm an investor, I'm looking for properties. If you know something, let me know. You are on the internet seeing what the market is doing. You are checking out foreclosures. You can even now, there's a lot of bankruptcies going on. You can check in the bankruptcy courts for properties. You need to get proficient at finding properties, okay? All right, so these are just some tips. I've got a lot of people asking me this. I'm excited that there's a lot of new investors out there, but I want you new investors to take heed to these 5 points and principles, okay? Get educated and make a plan, number 1. Number 2, master the property analysis process. Master it, don't just dabble, master it. Build your team, okay? Financiers, real estate brokers, property managers, lawyers, accountants, insurance folks, financial planners, okay? Build your team. Number 4, define your investment criteria clearly and stick to it. And 5, get good at finding deals. Don't be lazy, go hard, find those deals. Hope this has been helpful. If it is, please subscribe to the station, throw me a like, and share it with someone else. Share, if you got some value out of this, share it with someone else, because we need to get the proper education out there so that people can make wise investment decisions. Hope this was helpful. Look forward to seeing y'all on the next one. Peace.